We're now going to discuss percent risk per trade, which is an important topic of money and risk management. Okay, so as part of your risk management plan, you should learn how to trade in small steps or lot sizes. If you're not profitable with smaller lots, why would you be successful with larger lots? I know this is very obvious, but a lot of traders, when they first learn how to trade the market, they don't tend to do this. So it's very important to highlight this before you actually put any of your hard-earned money into the markets. Therefore, it is wise to start with 1% risk per trade and gradually move up to 2 once you feel you are comfortable and had enough success. Now, what exactly do I mean by enough success? What I mean by this is you've found a particular trading model that fits your style and your schedule and your risk appetite, and that you had enough success and enough confidence to see common occurring patterns reoccur over and over again in the markets, that you know the probability of the outcome. Once you actually know this, then you can start increasing your risk, gradually up to 2%. It is not wise to actually use more than 2% risk per trade, because if you have if you go into a losing streak, which all traders go into eventually, it's only a matter of time when a trader goes into a losing streak and he loses a couple trades in a row. And this is perfectly normal, and this is actually should be expected when you first learn how to trade. When you first learn how to trade, you actually have more risk, as we highlighted before. So it's actually not uncommon to see this. So this is one of the kind of things you want to mitigate at the beginning. So for instance, if you have $1,000 account and you're risking 2% per trade, that is $20 of risk per trade. So you're going to have to place your stop loss in a position where it's $20 or less. Okay, so this is the idea. So if we see a pin bar, as we saw in the risk to reward ratio video, your stop loss would be in a position where it shouldn't be risking more than $20. If it's risking more than $20, then you probably want to lower your lot size in order to risk a little bit less per trade. Okay, so for example, if the above was implemented and you have a losing streak of 5 consecutive bad trades in a row, you will have still preserved 90% of your account, right? So 5 times 20 is $100. So this is in essence what could be expected when you're a trader. Even if you have a little bit more experience and you've been trading in the markets for a few years, losing 5 trades in a row is not something that is that you can rule out. Absolutely not. There's no guarantees, right? So this is definitely something you want to look in for, and you want to plan. And proper planning involves understanding of what risk is and how to mitigate all these risks, right? So in essence, what we plan to do is use a percentage of risk in terms of your capital in your account. You don't want to risk a fixed amount, and the reason for that, as we'll see in the next slide. Okay, so for example, here we have a chart that identifies a winning streak of 20 trades in a row and a losing streak of 20 trades in a row, and applying 2 different scenarios. The first scenario, where we apply a 2% money management rule, where we're actually risking 2% per trade for the account, and in the second scenario, where we're not applying a 2%, but instead we're applying a fixed capital amount. Okay, as we can see at the end of the 20 trades, with applying a 2% rule, we can see that we are at the end of the 20 trades with a balance of 148,595 as opposed to 140,000. So applying a 2% rule as opposed to a fixed capital amount will amplify your gain. On the flip side, when you're losing, let's say you lost 20 trades in a row, and applying a 2% rule, it actually softened the blow. As we can see, your end balance of your account is 66,000 as opposed to 60,000. So, and this is what really we want to do. We want to amplify your gains and minimize your losses. And the only way you're going to be able to achieve this is if you actually use a fixed percent risk on your account as opposed to fixed capital. Okay, so let's look at the next chart here. We actually see a visual representation of what we just discussed, right? So how we can see how the green line represents the 2% rule and the red line a fixed amount. So we can see it amplifies your gains on the way up, and the green line shows how it softens the blow on the way down. Okay, so this is basically what we want to be using. We want to be using fixed risk as opposed to having a fixed amount of risk per trade. So again, just to emphasize, when you're first learning how to trade, you want to risk small lots. You don't want to be risking anything that will put your account into jeopardy. You know, risking more than 2% per trade is stupid, and it should be not done at all, especially at the beginning when you're first learning how to trade.